Hello, my name is Bruce Rector, and I'm here to talk with you today about the seven deadly sins, common pitfalls to avoid in business, pitfalls that I see more often than I'd like in the course of my consulting activity. I'm going to give you a brief introduction to the Rector Group, then we'll go over the seven deadly sins and why it's important to address these issues, truly address them, not just sort of kick the can down the road, but put them to bed, and then a little bit of good news in connection with all this. The Rector Group is a provider of high-impact consulting services, and we're focused on middle-market, closely held companies. We specialize in strategy and finance, and we're completely industry agnostic. Now, before I get into this, I want to have a brief disclaimer. Samuel Johnson said many years ago, men more often need to be reminded than to be taught. And this is particularly true with these, what I call the seven deadly sins. These are business issues that you've probably all been spoken to about more than once, but sometimes we just need to be reminded that we got to take the next step and really put these things to bed. So if you can imagine a drum roll, without further ado, let me list out the seven deadly sins. Lack of a clear mission, no view of the future. It's not linked to strategy, isn't linked to execution. Don't understand the economic model. Poorly written governance documents. Lack of internal controls. Insufficient human capital. Insufficient financial capital. Let's talk about lack of a clear mission. I know it sounds like mom and apple pie, but every company needs a mission statement. It defines who you are, why the company exists, and it provides a framework, even a foundation for the strategy. Obviously, the best mission statements are going to be congruent with management values. The mission statement for the Rector Group is: the Rector Group exists to provide world-class finance and strategy consulting services to a traditionally underserved market, middle market companies. You obviously need to know where you're going in order to get there, and a mission statement sets sort of the long-term target or goal of the company. And it needs to, I don't know if it's going to specifically summarize the company values, but it should really reflect the company values and how you intend to do what you're going to do. It needs to be revisited periodically simply because sometimes companies do change. If you think of IBM, they started out as a mechanical adding machine manufacturer. Now, obviously, they do something very different. Sometimes companies will shift significantly, and the mission statement might need to be revisited. And it is the foundation of your strategy. So the strategy really is built on the mission statement. No view of the future. I've seen situations where the strategy really isn't linked to execution. You have a mission statement, you've articulated a strategy, but you haven't really figured out how to execute. We all saw Field of Dreams. That's the only case where building something and they will come seems to work. You can't just put something out there without a thought about execution, how you're going to bring your product or service to market in a practical way. And that needs to contemplate two potential outcomes: rapid success, which means you might need to raise capital to build infrastructure because suddenly you've got to, I don't know, build more facilities or hire more people, or delayed success or even possibly failure. And that might mean needing to raise capital to get the company to success. It also, there are going to be liquidity implications. You're not getting revenue as quick as possible. You got to manage your cash. And part of that is managing costs. And management needs to be aware of both of those possibilities. Don't understand the economic model. Without getting into detailed accounting, it ignores the impact of capital expenditure, so that you might think that net income equals cash flow. The biggest example of this that I've experienced is a large company I once worked for that had reported record net income with an $800 million negative cash flow due to certain investments. The opposite of that is thinking cash flow equals net income. And that's where you maybe get a big deposit, but you're actually losing money on the business. So you bid $1 million, you win the bid, you get a $500,000 deposit, but it's cost you $1.1 million to deliver the service or product. What it boils down to is you need to truly understand the moving parts of your business and how these parameters impact your bottom line. Poorly written governance documents. This is sort of the Mac Daddy of the seven sins, and I'm referring here to operating or shareholder agreements. And they should capture on paper the relationship between owners. They need to designate authorities, responsibilities, and especially buyout provisions in case of the death or disability of one of the founders, as well as documenting the ownership. I've actually seen it where nobody bothered to write down how much of the company they owned. You need to spend money and effort appropriately drafting these documents, or you run the risk of spending a lot more money, a lot more time and emotion litigating to solve some of the issues that this would address. Lack of internal controls, and I'm speaking here really about accounting controls. It's an immediate red flag for prospective buyers if you're thinking of selling your company. It will come out in due diligence, and it will negatively impact valuation because it implies that your numbers are not perhaps as reliable as they might otherwise be. Some of the things that need to be addressed in controls, just responsibilities, and I'm thinking particularly around the ability to write checks and keep the books need to be segregating. You need to have appropriate spending authorities in place who can spend how much, under what circumstances. Accounting controls where the person writing the checks can't do the accounting and hide their, if they're committing fraud, hide that. It provides transparency in business affairs to the owners. It's a big benefit. If you have an outside accountant, they can help you assess the quality of your controls and help you put appropriate controls in place. Insufficient human capital can be a lack of management resources where the CEO does everything, chief cook and bottle washer. Often, CEO is kind of managing by crisis, ricocheting between crisis to crisis. It might require financial capital to remedy. You might need to hire more people. It can also be misalignment of resources. Companies outgrown management. A team that was great at $15 million in revenue is not great at $100 million in revenue. It might mean a cultural mismatch between a person and the company. And it might mean that the person is more appropriately in sales rather than in marketing or general management, for example. If you have outside advisors, they can often provide insight and assistance in dealing with that issue. And then finally, insufficient financial capital can constrain growth if you need the money to put in hires and infrastructure to grow the company, but it can be a chicken and egg issue where the investors don't want to put the money in if you're not growing, but you can't grow without it. It can be very tough. If you're looking to raise capital, I will tell you it's very distracting to run a business while raising capital. You have to create an offering memorandum containing projections and research. You go to road shows, which really just means meetings and more meetings. It's almost like a second full-time job. If you hire someone to raise this capital, by the way, they should be a licensed broker-dealer. And why is addressing these issues important? The long-term success of the company hinges on these issues being resolved. If you're looking to sell the company at some point, it'll enhance the probability of that happening and possibly the valuation. Your life will be better just because more structure in the business means less stress for you. And if you're looking to raise capital, it will be easier if these have been addressed. The good news is that the first six can be largely controlled by you. The mission, the view of the future, understanding the economic model, especially the governance documents, human capital, and lack of internal controls can be substantially handled by management. If you aggressively address these, the seventh issue, raising capital, will be much easier, and it might reduce the need for capital simply because the company will be running better. You may remember some ads that the government ran some years ago where they would show a frying pan with an egg. They would say, this is your brain on drugs. Well, if you can imagine this as an analog for your company, this is your company, and this is your company if you don't address these issues. It will ultimately go away. Thank you very much for your time. You can reach me at this phone number and at this website. Thank you very much.